We're joined by Loeys from JPMorgan Chase. Good morning, Jan. Thank you for coming in to see us this morning. I suppose we're kind of waiting with bated breath to find out what those GDP numbers are going to say. Do you expect they will be lower?
We think indeed a two-handle, but we're a bit higher in consensus. We're at 2.8, but confirming that this is not a 3% economy in the second or in the first half. So I think people know already broadly what the components of GDP, no big surprises there. Issues now in coming months. What is the industrial production slowdown in the world going to look like? And we think it is slowing from a double-digit growth pace over the past year. It's still going to be 4 or 5% overall, so it's not as bad as what is feared.
Now, we're looking at a lot of very good earnings figures coming out, but then when you dig a little bit deeper, most of the profits are actually coming from emerging markets, be it Telefonica in South America or Volkswagen in China. It does appear that it is the BRICS that are leading this absolutely clearly, right?
Yes, at a sharp edge, it is emerging markets. They're growing at least twice the pace of the developed markets.
So do you see a slowdown then in those emerging markets?
Yes, because they rely more than the old world does on manufacturing. And manufacturing is an inventory cycle which is pretty much complete. So yes, big slowdown is going to be in the Southeast Asian rim. Largely due to industrial production.
And yet you seem quite confident that that slowdown is not going to lead us into a double-dip recession.
Not a contraction, but I think we were thinking more in terms of malaise, a underperforming global economy. 2.5% to 3% over the next year, which will not resolve the unemployment problem and which will get us closer to deflation, yes.
And if we look at the US, there's some specific problems there. We've had a lot of cautious words out of the Fed there. Right. We're also seeing problems with the property market there and unemployment and consumption.
Yes.
It does seem like there's not an awful lot of positive news.
Well, positive for whom is the whole issue. We're not going to grow gangbusters. The issues are we going to be contracting. So we think largely, indeed, 2.5%, maybe 3% growth is what we're going to get. It's not much to write home about, but it's better, obviously, than a contraction in the economy. It's very positive for credit product, for spread product overall. I think the bond markets, the overall government bond markets have rallied already a lot. There's not that much upside in that, maybe a little bit. If you want to get rich, you want to be in the credit markets at this moment.
And what about Europe? We've been looking, obviously, we've had the stress tests. The banking sector generally in Europe, has it come out of them well? Has it made much difference?
Well, the big surprise was actually in the south. We were all afraid that Germany was going to be very tough on its banks. The Spanish were the most tough. They provide a lot of information that we didn't have before, which is making us a lot more positive about Spanish banks. They clearly still have a lot of troubles, but it's not as bad as what is feared. I'd say stress test, neutral to positive for the market. More important for the whole banking sector was Basel, the Basel III announcements, which basically telling us now is not the time to crank down on the banks. Let's wait a few years for that. And that is boosting very clearly the banking sector.
Okay. Jan Loeys, thank you very much indeed for joining us this morning.